Hello and welcome to the Fintech Newscast. My name's John, and this week we'll be talking about what the coronavirus is doing to the world of fintech, new interest in contactless payments to avoid the spread of the virus, Instacart comes out with a same-day card issuance to your mobile wallet, and 4 hurdles that every fintech must overcome. Please hit subscribe to keep up with these and the latest in fintech news. All right, welcome to the Fintech Newscast. With me this week is my co-host, Steve.
Hey, John, good to not see you in person.
Yes, we're avoiding contact to avoid the spread of the coronavirus. So, Steve, you're suspect. I heard you cough a little while ago.
Yeah, it's called social distancing, John. Get on the bandwagon.
Yeah, that's one of the recommendations, social distancing, which we're practicing. Actually, not because of this, but just because of our schedules. The other thing is, please wash your hands before you hit the button for the Fintech Newscast. We don't want any infection, but it's just affecting everything. The markets, the WHO declared the coronavirus a pandemic. Italy has over 10,000 cases, and it's pretty much shut down.
It's actually, I think, a great time to buy some tickets. I saw tickets to New York from SFO for $177 round trip, which is an amazing deal. So if you're less risk averse than most people, by all means, go to Italy on your Corona vacation for $3.
Well, if you can book it for way ahead, that could work out.
That would be great.
But maybe right now, if you go, even maybe New York, where a lot of the main attractions will be closed down or just not as fun. Yeah. But there's that. Interest rates are heading towards zero. I just saw something that all the big banks are expecting rates to hit zero. We had our first rate cut here. The Bank of England just cut rates. So it looks like we're going to be living in a near zero or 0% environment for a while. So I think we can bake that in for a little bit.
Until we go negative, right? Yeah, I think that it seems like they're the arrows with the monetary arrows. Yes, it could always be worse. It seems like the monetary arrows have really run out. We have no more arrows. We can not go any lower than this. So it maybe not now. It may be a matter of just going with some fiscal policy and actually injecting money into the economy. Yeah.
But refinancing and mortgages are booming actually with these low rates.
They are, yeah. I'm actually in the market right now going through that process because it's incredibly low.
So a lot going on with the world getting affected by COVID-19. And if you're a fintech, there's some specific things that could affect you. If you're like a Robinhood and you're doing something with the markets, you might see a change in your volumes, people avoiding the markets. And if you're a wealth management firm and you see these market values tumbling, that's going to affect your revenue if you're one of these robo-advisors.
I'm in it for the long term, 5-10 year plan. So this is a dip. It'll hopefully be temporary, but I don't see a lot of long-term economic effects more than a quarter or two in the market. So if you are able to bear some of the risk and if you have the capital, by all means.
Well, yeah, but as John Maynard Keynes once said, the markets can stay irrational longer than you can stay solvent. So hopefully you have a lot of that investor money packed away if you're getting negatively affected, because you'll probably need it with all the negative effects. And not just robo-advisors. If you're someone like a Square that's taking credit card payments, there's going to be less transactions. Yeah, you're going to have a negative effect. You're going to have to adjust your plans. If you're a consumer-facing fintech, you're definitely going to feel the effects. Someone like Chime, who's making money on transaction fees, is going to see a hit. And not just the robo-advisors, but the actual real economy is getting affected, right? People are going out to restaurants less, and the concerts are all getting canceled. So that's going to take a hit to everybody that's depending on those transaction fees.
Yeah, I just saw that today the Warriors are going to play a game, I believe it's tonight or tomorrow, to an empty stadium. So all those concessions, all those transactions, or all the credit card purchases will not take place during that day. So definitely a lot of knock-on effects.
It's good to have hopefully you've extended your runway and have a large chest of money or some slack in your budget for something like this. Definitely, I think we could say it's a black swan, completely unexpected thing that you couldn't have had in your business plan even a few months ago. Venture capital money might be affected too. I mean, you're looking at long-term investments as companies take to build, but I can see how, especially if you're looking at funding a consumer-facing fintech, how you might be hesitant and look at more factors in your potential investment portfolio. So if you're looking to raise money right now, you'll have a few more questions. The other flip side of that is that venture capital firms and private equity have a huge amount of cash. It's estimated that they're sitting on $1.2 trillion, according to PitchBook. That's just waiting for the right kind of investment. So there's some pressure on the investor side to get that money out there, even if they, might be a little bit more hesitant. I have a few more questions for you and how this might affect your business plans.
Yeah, I'm actually a little bit skeptical about the effects that this could have on venture capital and on risk capital. I think that typically they're looking to play more longer term bets, and this is sort of a temporary dip again, 1, possibly 2 quarters. But also because of the monetary response to the crisis, i.e. lowering interest rates, there's now an even greater urge to chase yield, to chase returns. And, we all know that VC can be one way to do that. So this may have the opposite effect of actually increasing VC funding as they seek to, again, deploy all that capital, especially in a very low interest rate environment.
Yeah, well, if I was an investor, I might play this into some fear to get a better valuation out of my, a potential company I'm investing in.
So devious.
On the plus side, if your business plan relies on video conferencing or some kind of remote technology, you might be doing much better than otherwise.
Yeah, I bought a Zoom license so we can record more interviews and more podcasts over Zoom. Part of it because we can again reinforce that social distancing, but also because it just makes sense. So we may see Zoom stock skyrocket, for the next few weeks.
Yeah, and one of those technologies is contactless payments, so you don't have to touch anything directly, right?
Right, yeah, and it's actually a really interesting study from a company called The Futurist that came out sometime this week that actually highlighted how a lot of consumer sentiment is changing because of the coronavirus. So this study was looking at the effects or the potential uptake of contactless payments. And, there's essentially, they have two lines here. One is that before this became a pandemic of sorts, 41% of customers said, I do not need contactless payments. Now, well into March, they found that only 33% of customers now feel that way. So they've seen both a reduction in the number of consumers who think contactless is not a useful technology, and also on the flip side, an increase in consumers who also want to see more contactless payments. So if you go to a point of sale terminal, you have to put in your card, and in some cases put in a PIN number as well. With contactless, you can just basically tap your phone on the device, and this actually could be what propels the US to join East Asia and Western Europe in adopting contactless payments on a more national level.
Yeah, we talked about how examples of in the UK, how they've been using contactless payments to get on the tube for years now. And in China, of course, it's pretty much a commonplace to not use cash, to just use QR codes, and contact and apps for everything, to pay for everything. And this might be the driver of a change and away from cash, which can be very dirty. I don't know. I wouldn't say, I haven't seen anything that's officially this can be a transmission device for any virus or illness, but there is that fear that's going to drive that behavior, right?
That's right. Yeah. And there's also the issue that if you bank at a traditional bank and then you have to go to the ATM and take money out, ATMs are, filthy machines. So people are arguing that maybe this is a good driver for, again, that contactless technology. So that, for example, I know that Wells Fargo has a promotion now that if you use Apple Pay to get money out of the ATM machine so that you don't have to actually punch in a code, if you'll do it all through NFC, they'll give you $5. So I think the combination of both getting $5 and using contactless will hopefully drive usage of this product as well.
Yeah, for sure. And if you don't think that's a big deal, just think of every sick, coughing, sneezing person that's going up to that same ATM machine, and you'll see a big driver up for NFC.
I remember a few studies from a couple of years ago, 94% of banknotes were infected with pathogens, including E. coli, salmonella, and staph. So there's a lot of dirty stuff on our money now. So hopefully we can move away from money more towards either cards or just use your wallet to pay for stuff.
Well, money is notoriously dirty and filthy, and it's always scary when I see those studies about how much bacteria and viruses are on any random bill.
Yeah, and even I believe in China now, they're essentially subjecting all their banknotes to low-level heat and I think ultraviolet light as well, so they can disinfect the notes. So I know Korea and China are doing this.
And again, we're not saying that we've seen anything or there's been any alert about cash being a transmission device for the coronavirus or anything else, but that doesn't mean it's clean either.
Yeah, we haven't. It's just, I think it's just an overabundance of caution.
Yeah, another way to be contactless, if you will, in a general sense, is to avoid having a card altogether.
Yeah, so Instacart just announced recently that in a partnership with Marqeta, the company based here in Oakland, they are able to, if you sign up to be an Instacart runner, so if you're a person that actually will buy groceries for some lazy rich person at Whole Foods usually, they can now issue you a credit card and provision it into your mobile wallet within a day. So the process before is that you had to essentially sign up to be an Instacart runner and then get a physical credit card mailed to your address, which you would use to make the purchases. Now with this partnership,
how they do that?
That's what they did before. Yeah. So you got basically, yes, it was a very slow process. Yeah. Now it'll be you sign up and within a day, I think after maybe a credit check or so, they can issue you the card and provision it into your wallet within a day so that you can pay for stuff. And they can also control where you use the wallet and the amount as well. So the way that the process works is that if I say, John, go buy me whatever a gallon of milk on Instacart and it'll cost this much, Instacart knows how much it'll be with taxes so that they pre-approve that transaction at the store for that amount for the runner to do it.
Yeah, I love that flexibility being used across more and more use cases. I guess they had to work out some authorization bugs to get it out there, but it's I love when it's flexible, quick, and easy to manage like this.
It just works.
Well, one thing that doesn't just work is creating a fintech and running with it. Yeah, there's an article with a friend of the podcast, a recent guest, Daniel P. Simon, who just came out with his book, Money Hack, or is to be released in April. And he talks about 4 hurdles that every fintech startup must overcome, and we'll add at the end of that, besides coronavirus. So these are perennial issues. The first one is, he calls it navigating the U.S. regulatory market, which is very cumbersome. There's not just a federal approval for things. In some markets, you have to get approval in each state that you operate in, which is, I always see as a big, a strength in terms of flexibility and being able to experiment in different states. But if you want to expand, then it becomes a hurdle as you have to go through. And really, he recommends partnering up with the regulators or partnering up with someone that's done that already, like existing banks or financial institutions in those states that already have all the proper licensing.
What's number 2?
Number 2 is launching before the product is ready, which I can totally see. If you've been working on something for a while, a few years, and you're finally getting close, and investors have their money tied up in you, that there'd be all this pressure to launch. And he's just saying, just be careful that you don't launch and trip all over yourself on that first impression with your target market. You can't go back and recreate that first impression. So you mentioned like software and cloud-based services, which there might be more pressure on those because you can always fix it later, and maybe there'd be more pressure to launch and just, well, I'll just fix those things later. But again, you might be, you might not get a second chance with some people.
Yeah, we tend to harp on this, but it makes sense. This is launching a fintech company isn't as easy as launching some sort of consumer tech company, right? There's a lot of regulation. You can't easily pivot. And also, my Twitter or even my email can be down for a few hours, not the end of the world. My money, not so much.
Well, for some people, they freak out if their Twitter is down for a little bit, but some people in the White House.
Yes.
And we just saw something. Now, this isn't a premature launch, but about that kind of business resiliency with Robinhood. They've been having outages the past week. I think they're at their third outage.
I think it's
today or yesterday.
3 in 2 weeks. So a lot of there's actually a Twitter-led sort of group of folks who want to now sue Robinhood for potential losses because they weren't able to buy into the first dip. So yeah, there's a lot of real world ramifications to not having a very robust platform. So I think maybe they either didn't foresee the demand or something else happened on their back end, but kind of a poop show for Robinhood right now.
Yeah. And just to emphasize, I've heard a lot of young people especially say, hey, get on Robinhood before everything was free. And they have free trading. They have free trading. Well, they have free trading, but you could lose much, much more than years of free trades in one bad trade or in one loss like this, if you missed out on an opportunity like that. So there's free trades, but if you're giving up something that could cost much more, that's not really worth what you think you're going to get out of that. Free is not always the best route. So number 3, your concept might change. Now, I'm a big believer in this, in keeping flexible, especially as a startup. You don't know, you have plans, you have your business plans, but what makes money for you or what people are demanding can come out of completely left field. So keep that flexibility. Start with your idea and build on it, but see what other things come up. I mean, customers may tell you things, potential investors might have good feedback. And, there's so many examples where a company has started in one direction and gone a totally different way when they found customers were demanding something that they thought was going to be a sideline or just some small part of the company, and became the whole existence of the thing.
Yeah, this makes a lot of sense, and I think it's also something that we've seen a lot in with a lot of payments companies and just overall fintechs as they kind of change their product, change their strategy. So be aware that your product, your market, even your underlying technology may change as well. So being flexible can be really quite useful.
Yeah, it gives you an example of the founder of Lending Club, who I didn't know this. He created a credit card for kids and did okay, but there was all this interest from hedge funds and other investors who wanted him to head towards the Lending Club model that we know now, where institutional money could invest in, and that became the whole business. But yeah, I didn't know they started off with a very different idea. So
right.
So yeah, be flexible, and especially for fintechs. Number 4, the integral role of partnerships. And again, we mentioned the regulatory hurdles and the partnerships that you have to make as a result, and building up those partnerships, even as you think you might be competing against established banks, but you might be working with them and offering, products and value on top of what they're already doing. So you might turn them, instead of the old guard that you want to wipe out, into the platform that you build your business on instead. So the idea here that Daniel P. Simon is mentioning is just be smart about your your partnerships, be flexible overall, and you might not be disrupting one of your partners. You might be establish a great relationship. So with that, we'll go to our final byte, where we take a look at a number and the fascinating story behind it.
What's your number, John?
So my final byte is $150 million. And that's the amount that Fintech called Purely Capital raised. And what they do is they're a platform for entertainment, streaming, movie, TV, receivables. So it's not often that we get a Fintech article out of Variety magazine. But in this case, it's this is to do with financing film and TV production. Because what the world needs more of is more Netflix TV shows and movies.
More content.
And more content. So Netflix is actually one of the beneficiaries of this, along with Amazon, Disney, HBO, everybody that streams. Because the problem this Fintech is addressing, Purely Capital, is that let's say you produce a TV show or a movie to be streamed. You put out the money for it, of course, your production company or whoever, and you're not going to get paid back for that streaming, for the licensing contracts, until the next 2 to 5 years.
Oh my God.
So just like, so you have this cash flow that's going to be coming in, but you're going to have to put up the money for a while ahead of time. So just like securitizing any cash flow, and we've talked about this, of course, mortgages are the biggest market for this, securitizing the mortgage payments for years ahead. You can buy those. And of course, we see the commercials for lottery winners who have payments over the next 20, 30 years or whatever. They can get a one-time payment now and give up those future cash flows. And it's the same here, where basically they're securitizing the future income stream for their film and TV content. And I assume they'll have to have a contract already to stream with one of these major players. And they can get the money now and go on to their next project. And they don't have to wait for that money to come in. So it kind of speeds up the film and TV production process. The company itself has financed about $35 million in deals so far. So if you want to buy some future streaming rights, there's a platform to do that now. And of course, the cost is going to be the discounted cash flow, right? So what percent are you going to accept to have your money discounted at? So the higher the interest rates, the less money you'll get today. So I guess that's less of a problem these days with interest rates the way they are.
Right. It's interesting. It seems like even Hollywood cannot help but fall praise of fintech nowadays.
Yeah, the creative forces in fintech are helping facilitate financing in every market.
My final byte is $21 million. So this is actually kind of a crazy story. There's a payments company in San Francisco called Finix, Finix, and they're essentially a payments infrastructure company similar to what Stripe does, right? They help online merchants process payments and so on and so forth. Well, they had a funding round, and Sequoia Capital, the storied Sand Hill Road company, put in $21 million, I think, into the B round of Finix. Well, guess what happened? Sequoia realized that they actually had a bigger investment in Stripe, which is a competitor to Finix, and they essentially just pulled out of the deal, let Finix keep their $21 million, and also did not insist on having somebody on their board, did not insist on getting any information rights, and basically gave up all of its involvement.
What? So they didn't do so they paid the price basically for not doing all their due diligence.
Yeah, this may be a matter of maybe the partners not sort of sharing information, or just somebody dropped the ball on this, but it's actually quite commendable that the company was able to say, you know what, we promised you that we'd lead this round. You can keep the money. It's sort of a drop in our bucket in terms of our capital, all the capital that we have. And we'll even not take a board seat. So, and no information rights, which is huge again. So, this is a nifty little mess up that for Finix ended up, creating $21 million in unattached capital.
Wow, that's a nice little bonus for them. So if Sequoia Capital, if you want to invest in a podcast, we're open to your money there.
Especially if it's free money.
Especially if it's free money, yeah. Yeah. Well, it's a $21 million PR event, I guess. So it definitely helps brand them a little bit with being an ethical investor, I guess.
Yeah.
All right. Thanks for that. And thanks for listening to this episode of the Fintech Newscast. Please hit subscribe to keep up with the latest in Fintech news, and we'll see you next week.
See you later. Stay safe. Wash your hands.